Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome to another edition of Something More with Chris Boyd. I'm Jeff Perry. I'm sitting in for Chris for this episode. Chris is at a convention, a financial services, financial planning convention this week. And so I'm sitting in, and joining me is Brian Regan. Brian is a member of Team AMR. He is a senior portfolio manager with Wealth Enhancement Group and a regular guest on our show. Thanks for joining us, Brian.
Hey guys, how you doing?
Great. Also joining us is Russ Ball, the newest addition to Team AMR. Russ, thanks for working the control panel and joining us for this episode.
Of course, happy to be here.
For the people who click the podcast link, they'll see the title of this episode is Mailbag with Brian Regan. And what that means is Brian's going to handle a couple of questions that have come from clients and give us his opinion, and we'll have a dialogue on the issue. Brian, this first one came from a recent client review. What that means for the listeners who don't know is at least annually we sit down with a prolonged meeting, a couple-hour meeting with our clients to go over their financial plan that they have in place and discuss if they have any changes to their life or anything that they're concerned about. We follow up. And this particular client is a big fan of yours. He watches all of the webinars on the markets and the economy. He just, he loves that. Not everybody loves to dig in that stuff. I know you do, but he just loves learning more about it. And so this issue that I'm going to describe has come up repetitively in his annual reviews and conversations with him. And he's kind of been, I won't say stuck, but it's the best word I can come up with. He keeps hesitating on doing something that we are suggesting that he do. And this year it came up again, and he seemed more interested in doing something with this part of his portfolio. And he asked us, he said, would you pass this question by Brian? And I said, you know what? How about if we pass this question by Brian on the podcast and let him answer it? And he loved the idea. So we know he'll be listening to the answer, and we'll see how it goes. So let me, I know you know the question because I formatted it to you, but let me, for our listeners, read what I sent you. So this is a client who's about 70 years old. He's got about $100,000 in Verizon stock. He was an employee of Verizon, and like many employees of corporations, he acquired stock over the years. And he very much likes every quarter getting a dividend of about $1,600. It's the dividend on the stock right now annualized is about 6.5%. The client is looking for income, but he's concerned about the risk of this individual stock, Verizon, a potential decline in the value of Verizon. And thus maybe they don't have the ability to continue to pay their dividend. As a side note, which I didn't write in the email, Brian, during this discussion that we have with this client, the issues of the former issues with AT&T comes up because he was a holder of AT&T and similar concerns, and AT&T ultimately in the past had cut their dividend and shocked some people who had bought the stock. So that comes up in the context. Overall, the client has a moderate risk profile. He's not afraid of risk, but as he's getting older, he's becoming more conservative thinking. So the question is, what would you suggest he do? Knowing that he likes the income stream, what would you suggest he do with this $100,000 of Verizon stock?
All right, so I'm going to get into Verizon. Before I do that, I do want to get into some of the reasons on why I don't recommend buying a stock just for the dividend yield. As a general
good way to start, yeah.
Rule of thumb, I don't think that's a good idea. Okay. Now, oftentimes the dividend yield is high because a dividend cut is imminent. You mentioned AT&T, that did happen. It tanked the stock at the time. I believe they have the dividend, if I'm remembering correctly. So sometimes the high dividend yield could mean that it's just, it's just a mirage. This is a temporary thing. It's going to be, cut in half in the case of AT&T at some future point in time, probably very soon. That's oftentimes what the market is saying when it cuts the price down so much that the dividend yield looks high. Now, that's not always the case, and we'll get into Verizon specific after a few more points. Now, the other reason why, there's a few reasons why I don't like buying stocks just for the dividend. Dividend-oriented funds and stocks chronically underperform stocks that do not prioritize dividends. Now, there's 4 things that you can do if you're a company with your cash flow. You can reinvest in the business. That means more growth. So if you're prioritizing the dividend, you're probably not going to grow that much. You can pay down debt. That makes your business more secure. You're far more likely to go bankrupt if you have a lot of debt. You can buy back stock. This is really the same thing as a dividend, except it's much more tax efficient. You're going to get a capital gain. You can decide when to pay that tax on your own rather than getting it quarterly as the client is getting. And the last thing you can do is pay a dividend. Prioritizing a dividend at the expense of these matters can lead to worse overall performance, and that seems to be the case. If you look at any dividend-oriented fund just against the S&P 500, for example, it chronically underperforms. So I think it's important to keep those things in mind.
So, Brian, when you see a company, any company that's maintaining a high dividend, what are you thinking? Because they know these choices as well. Are you thinking that what are you thinking? I don't want to put words in your mouth. Why would a company pay a dividend so large when they have these other options, which fundamentally might be better for the health of the corporation?
Well, it might be the right thing to pay a dividend, right? It might be a very mature company that isn't going to grow very much. They don't have a lot of options to reinvest in their business.
Okay.
They might have a very reasonable balance sheet where, it doesn't make a whole lot of sense to pay down more debt. They might be buying back stock too. Maybe they're doing, half and half. Maybe they're paying a dividend with a certain amount, and maybe they're buying back stock. This is another problem generally with the dividend yield. Sometimes I'll see a company is buying back twice as much stock as they're paying a dividend. It looks like the dividend's very low, and people just ignore it, thinking that the dividend's not high enough. 1% is not nearly enough for me, when in reality the return to shareholders is more like 3.5% when you put in the buyback yield. Getting back to some of the things on how to create cash flow, which is oftentimes the problem when people are thinking about dividends. They like the cash flow, right? They want to create a new paycheck in retirement. Well, it would have been far better to hold Google, for example, which only recently started paying a dividend over the last 10 years, and just sell the shares as needed, than to hold Verizon. Over the last 10 years, Google's up 552%, and Verizon's only up 37.5%. And that's total return. That includes the dividend. So you're much better off holding the stock and selling some shares as needed and creating a paycheck that way rather than taking the dividend. And my final point on this before we get into Verizon specifically is if you really want income and stability, you're probably better off moving up in the capital structure and buying fixed income, especially where rates are today, right? So this is going to come into play when we start thinking about the value of Verizon. But if you just buy the iShares High Yield Index, for example, it's outperformed Verizon over the last 10 years while being higher in the capital structure.
Could you define for our listeners who may not be familiar with the term that you're saying, the capital structure, higher in the capital structure?
Sure. So the capital structure means the best way to think about it is the priority of payments, right? So you are contractually obligated to pay your interest expense on your debt. That is something that has to happen. If you can't do that, you go bankrupt and the equity goes to zero. So it's much more likely to be paid, and if it isn't, then the company's bankrupt and the equity of the company isn't worth anything anyways. So it's a much safer asset for that reason. It should be less volatile for that reason, and we see that fixed income is very much less volatile than equity. And dividends, for example, they are returns to shareholders, equity returns. They are not contractually obligated to pay that, so they can just cut it, right? You can't cut the payment to fixed income. You can cut the payments to equity holders.
Right.
It's perfectly fine, perfectly legal. You will not go bankrupt. So there's much more stability in buying fixed income. And if the yields are similar and there's no growth, all things equal, I would much rather hold the fixed income instrument.
Right. And to put this to the extreme example, if a company does go bankrupt, dividends are long gone, and shareholders, the shares that they own, they're last on the list to be fed, right, at the bankruptcy table.
Right, and there's a good chance you're going to get something back in your fixed income, especially if it's a secured asset. Senior secured assets generally return about 80% of the capital in bankruptcy. So they're much more stable, much more reasonable assets to hold if you're looking for quote unquote income.
Okay, let's dig into Verizon itself now. What we're going to talk about isn't a recommendation to buy a stock. It's not a recommendation to sell a stock. We're giving Brian's thoughts on the question that this particular client make, and past performance is certainly not any predictor of future results.
Right, so that's important. And despite everything I just said, rarely, but sometimes, a high dividend yield can represent an overlooked stock.
Right.
I think it's important to say it's rare, but sometimes it happens. It's worth looking, especially if it's a mature, well-known company with few competitors. Oftentimes, it's just overlooked and
Could just be a money machine, right?
Not popular in the
Right.
current stock market popularity contest.
Sure.
It's rare, but it happens. When it does happen, I love to take advantage of it. So that being said, we do own Verizon for clients that we manage money for on a discretionary basis for individual stocks. So let's get into why. The dividend of 6.46% is 5 times higher than the overall market. So it's not even close. This is much higher than the S&P 500, for example. So that is an indication that if it can pay the dividend, it is probably very cheap and has the opportunity for capital gains going forward because it's very cheap. The dividend is very well covered by the cash flow. So the free cash flow runs about $3 to $5 billion a quarter, while the dividend is $2.8 billion. So you can see that $3 to $5 billion is higher than the $2.8 billion. So it can reasonably pay the dividend, continue to pay the dividend. If interest rates come down, particularly long rates, or if spreads continue to tighten, and by spreads I mean the difference between a high yield instrument and a treasury instrument, if that difference continues to come in, I would expect decent price movement in this company to accompany the dividend, which is great, right? So I'll give you an example. We initiated the position much lower than the stock currently is now, which is great. And the expectation was that as interest rates came down, I would get price appreciation. Now, you might get the sense that I'm not planning on being in this stock forever, and that makes sense. I have a thesis that it's underappreciated, partly because it's viewed as somewhat of a fixed income type instrument, and that as rates come down, the price will appreciate. As the price appreciates, I likely won't want to be in this stock further as we realize that price appreciations. Now, all that's good, right? But there's real concerns about the stock. I don't think it's an obvious hold. I would say that I am looking at this as a source of funds if I find a better opportunity right now. I mentioned that we bought it lower. We've had some appreciation. We've owned it for a little over a year and a half. I've been happy with it so far. It's not like I have an itchy trigger finger on it, but if I find something that is consistent and going to grow for a long period of time, this might be a way that I fund that new purchase. So I don't think it's an obvious hold. The growth is flat to negative, which is unsurprising, right? It pays a high dividend, not reinvesting in the business as much, so it's not growing as much. So any price appreciation would have to come from that change in rates, or they would have to cut costs, pretty dramatically to grow the bottom line. Cutting costs would presumably make them less competitive in the future. This is an important point, especially since Sprint and T-Mobile merged to be a very competitive third provider of cell service in this country, right? There's really the big three. There's T-Mobile, there's AT&T, and Verizon. Before the merger, there was really AT&T and Verizon. Now there's a much more bigger competitive threat. There's a lot of evidence throughout the history of the stock market that a duopoly is great, and you add a third competitor, and things start to get a lot hairier for these stocks. Now there's a lot of debt on the business, right? I said that we could pay down debt and make the company more secure. This company has a lot of debt on the business. This company has more debt on the business than AT&T does. To your prior point, right? With a lot of it coming due in the next 12 months. So what does that mean? Well, it doesn't mean that they're not going to be able to pay it. They have about 20 billion coming in the next 12 months. I mentioned that they only have 3 to 5 billion in cash flow per year. So they're gonna have to refinance the debt, similar to how you would refinance a house. They're not going to pay down the principal completely with their cash flow. What they're going to do is finance that money with higher yielding debt than they currently have, just because rates have gone higher. They are an investment grade company. I don't expect this to be a problem. But you can see that over the last few years, as rates have gone higher, this has eaten into their net income as interest rates has moved higher. So that's another reason to be concerned about the future of this company. If we're already growing at flat to negative, this can only be a bad thing.
And aren't they making a big acquisition or soon?
They are. They're buying Frontier Communications. This is going to be my next point,
okay,
for $20 billion in all cash. So the transaction will need even more financing. Most acquisitions turn out to be a bad idea. I do not know enough about Frontier Communications and Verizon's business to make a judgment on whether or not it's going to be a bad idea. But I do know that about 75% of acquisitions end up being poor acquisitions. So, I wouldn't bet on a 250 hitter getting a hit when he comes up to the plate. And that seems to be the odds that I'm handed here. Not, and moreover, I know for a fact that my interest costs are gonna go up. So the bottom line is, I've held the stock for over a year and a half. For me, that's not a long time, and done fine with it. But it'll likely be a source of funds because it does have some hair on it. The dividend seems safe for now, but there's a lot of debt in the business, and we're hoping to benefit more from lower interest rates, which seem less likely now than they seemed, probably a year ago to me. So we've done well in it. I'm happy about that. There is some hair on the stock. If interest rates continue to move lower, that would be very good for the stock, but I think that's less likely to happen than it has in the last year. We see spreads at at historic tights. We see inflation expected to move higher now in 2025, at least by a little bit. And those things are not good for the downward trajectory of interest rates. So the reasons why we like the stock in the first place are largely going away, and there's been some price appreciation. So the stock's fine. I don't love it. I wouldn't own it just for the dividend.
Yep. And just kind of a side comment here about financial planning principles generally. We attempt to discourage individuals, clients who have a concentrated holding in a single holding, and depends on the size of their assets, depends on their net worth and how it fits into their whole financial plan. But generally, we don't like to have our clients have a single holding represent more than 5%, for example, of their entire portfolio. And so, that's an individual situation. We're not going to get into the details of this client, but if it's if you acquire a lot of stock, like in this case, this individual did while they're working, and it's normal that clients and prospects come to us and they're retiring and they have all this company stock. And one of the common things that we discuss with them is it prudent to have all of this stock, all this value, all these assets in one holding, even if you love it, even if you don't have any concerns about it. Maybe you worked in the industry forever, you're confident in the trajectory of this company. It's not prudent for the principles of diversification to have so much of your assets invested in one company. The risk is just too great. Russ, you probably see that with some people that you've been talking to where they have a concentrated holding, and the advice that we typically give them.
Definitely. I think it's been a conversation I've been having a lot recently. Also, we talked about it on a recent podcast episode. some of the risks of having too much in one specific stock, but it's also, one stock, but also a specific sector. So it could be a lot of, different companies, but they're all concentrated in one specific group, maybe a telecom, maybe technology. Obviously, technology has done really well recently, but maybe Brian, you have any thoughts on sector diversification and maybe certain limits that you'd want to cap yourself at if you're looking at one specific industry?
Well, I don't want to talk about specific caps or limits because I don't like to talk about hard rules, but I will say that I see this mistake a lot. I see people hold Verizon, AT&T, and T-Mobile, and they think they're diversified. When you add them up, it's a very significant amount of the portfolio. I see people own Verizon and MasterCard a lot. It's essentially the same business. You can see, especially these days, you can see a lot of NVIDIA, a lot of AMD, and then they'll have a semiconductor ETF. It's what I like to call it is the illusion of diversification.
Yep.
Sometimes you'll see people with 3 or 4 dividend ETFs, and when you look into the top holdings, they're all the same companies.
They're all the same companies.
So I call it the illusion of diversification. You're not really diversified. It just looks like you are because you have 4 tickers, but you're very concentrated in a sector or a type of investment. And when that goes out of favor for one reason or another, you're going to feel it more than you probably expect.
Thank you, Brian, for your comments on that one. Let's go dig into the mailbag and ask the next question. So this is a couple who are in their 40s and they're saving for retirement, like most people. They're using their 401ks, which is real common. Their risk tolerance is high. They're very tolerant of taking risks. They know they get a long runway here, and they don't expect to use these funds until they retire. They have 401k funds in a model portfolio, one of their choices, and it has 25% exposure to international stock funds. So they were digging in, they were doing their research, which I love to hear that people are looking at what's inside of these funds. And they believe that they found that the return on international stock funds has lagged the U.S. stock funds for a long time. And they're asking, they understand diversification, what we were just talking about, in this case being diversified to international investing as well. But they're asking, should they continue to keep a portion of their funds in their retirement account exposed to international equities after a period of long underperformance? And if so, why? And if not, why not?
It's a great question, and one that I ask myself all the time, honestly. And I wrote down some thoughts for the pro all U.S. argument and the pro international diversification argument. And then I'll tell you how, I personally treat it and how we treat it from the vast majority of our clients. So the pro all U.S. This particular couple is correct. U.S. stocks have done much better than international stocks over a significant period of time. For this analysis, I looked back. I believe it was a 10-year period, and I think there was a 13% return on the S&P 500, and the MSCI All Country World Index ex-US was up maybe just over 4%. So there was a big difference between international and US over the last decade. And 10 years to me is not a short period of time. I'm constantly preaching let's think for the long term, and most people incorrectly, when I say that, think 3 months to 2 years is a long time, but
That's
no, I'm thinking much more than that. And this couple seems to be on the right page, right? They're thinking over 20 years. They're looking back over 10 years. Hey, look, it's really hard when you look at this past data and say it makes sense to invest internationally when you look at the performance data. In addition, there's a really good argument that large cap domestic stocks generate enough revenue from international countries where it's unnecessary to further diversify into those markets. This was a popular stance from Vanguard's John Bogle before he died. The other thing is U.S. has a relatively attractive demographics, at least now, compared to the rest of the world because of the increase in immigration that we've had. We have generally younger demographics than a lot of the developed world, and especially that of something like China. So that's the argument for all U.S., and I think it's a strong one. So I'm going to make the argument for international diversification.
Before you do, Brian, I want you to dig into that a little bit more about Vanguard's posture, and you've shared it with before, but for people who haven't heard you before, why are you saying that a positive for all U.S. already kind of gives you some exposure to foreign markets?
Well, you're gonna get exposure. Let's say some company domiciled in New York City, is a multinational corporation, right? That means they sell in Europe, they sell in China, they sell in Japan. They're gonna have currency exposure in all those countries because they transact in euros or yen or yuan, and they're going to have exposure to the consumer in all those countries as well. And I looked at this recently, and don't mark my words, because I'm doing this off the top of my head, but I think about 30% of the revenue of the S&P 500 is generated internationally. So you're going to have a lot of the benefit of the international consumer, just by holding the largest 500 stocks in the United States.
Very good. Thank you for adding that commentary on that. So go to the other argument of why we should have direct international exposure in our portfolios.
Yeah, so 10 years is a long time. I mentioned that earlier with the US. But most of us are probably going to be investing for longer than 10 years. I hope to be investing for the next 60 years of my life, for example. That means I'll have a very, very nice long life, one that I could be proud of. But in reality, I'll probably be investing for longer than those 60 years, because I hope to get to a point where I'm investing for my heirs, to a certain degree. So if you're older and you're thinking, I don't have 10 years, the likelihood that you're investing for longer than 10 years is probably very, very, very high. Oftentimes we see that people are outliving their money. So you might want to think in increments that are much longer than 10 years. And I will say that, I'll admit that 10 years is a long time. If an investment's not panning out over 10 years, you might want to rethink your thesis. Now, why is that important? There are long stretches where international stocks outperform, including the late 80s and the early 2000s. Now, the late 80s and the early 2000s, that's well within my lifetime, and that's long within the time that my parents, for example, have been investing. So you might want exposure to take advantage of those opportunities. If a client's investing for many decades, this is evidence that it might be helpful to have an international allocation. Many people believe that part of the reason for the international underperformance has been the extent of dollar strength, and if the dollar to weaken, then international would benefit. This is a reasonable argument, and year after year, I hear people say that the dollar is too strong relative to global interest rates, and that's fine. Now the problem is the dollar keeps getting stronger and stronger relative to international companies, so we can't see if this thesis is true. But what this is important for is saying that all the data that I've talked about is historical data. This says nothing about what's going to happen in the future, right? We talked about the returns over the last 10 years. We talked about returns outperforming in the late 80s and the early 2000s. That was all a long time ago, and we need to be forward-looking as investors. This argument is a good argument about being forward-looking. Now, there's also a very good argument that international stocks are much, much cheaper than domestic stocks. The price-to-earnings ratio is about 8 turns cheaper, and the dividend yield is about twice that of domestic stocks. So, on those two very common used metrics for valuation, international stocks are much, much cheaper. I would argue that there's some good reasons for this, mostly that they're not growing as quick. But they're not growing as quick because they don't have technology industry that is as robust as ours here in the United States. Now, how do we put all this together? And what do I do personally, and what do we do for our clients? Well, personally, I do have some international stock positions. So the way my personal portfolio is, which I become more and more convinced that it's helpful for people to tell them what am I doing with my money.
Sure. People
I
want to know that,
I
right?
invest very much alongside with our clients,
Mm-hmm.
but about half my investment portfolio is in index funds, and about half of it is in individual stock positions. So on the index funds, you can say for all intents and purposes that I'm in the S&P 500, and on my individual stock positions, I have international stocks in there. Now, why do I think that's good? Well, I don't do it specifically because I want international diversification, even though I think that's an added benefit. I do it because I think that they're some of the best in class companies, and I want to buy the best in class companies when it comes to my individual stock portfolio, regardless of where they are domiciled in the world. Not necessarily regardless. There are certain reasons why I wouldn't want to hold Chinese stocks, for example, even if they tend to be very, very good companies. But generally speaking, I want to hold the best companies in reasonable countries. And that ends up being about 10% of my individual stock portfolio. Now for our ETF mutual fund portfolios for individual clients, we utilize an active mutual fund that's pretty concentrated. So what do I mean by that? Well, some of the best companies in the world that I mentioned that I might have in my individual stock portfolio are going to be some of the top holdings in this active mutual fund. And that's one of the reasons why we choose to use that. We've been underweight international against the MSCI ACWI index, which the reason which is I'm really stripping out China. I don't really like being in China exposed stocks. As a replacement, I've chosen to be in emerging market bonds. And that's been really great for us because in recent years, it's giving us about the same amount of return as those international emerging market stocks, but with much less risk, and that's benefited for us. So that's how I do it personally, and that's how we're doing it for the vast majority of our clients.
Russ, did you have any questions for Brian on the subject of investing internationally?
Yeah. I guess when you're looking at opportunities to invest internationally, are you looking at, you mentioned specific companies that you just think are really good companies. That makes a lot of sense. Are you ever looking at specific regions as potential areas where opportunity can evolve based on the growth story? Or, for example, with some of the nearshoring developments that have gone over the last several years, I know a lot of analysts look at some emerging markets as potentially higher growth opportunities than developed international markets. What are your thoughts on that?
I think the story is different when you think about funds, and it's different versus individual stocks. So when I buy international stocks, the individual stocks of the individual companies, I don't think of it any differently than I think of my allocation to domestic stocks. I'm looking for consistent companies with growth. So, what does that mean? Well, think about some companies in domestic markets that might have near monopolies. Think about companies that are predictably growing margins that trade at fair prices. That's what I'm doing when it comes to the individual market. Now, that has very little to do with kind of short-term trends. I'm looking. It's more about what I expect it to do in the long term. Now, when it comes to funds, we do have a strategy called the 60/40 Core Explorer. Now, the Core Explorer is the core part of that portfolio is the strategies that we would utilize because we like them for the long term. The Explore part of that portfolio would try to take advantage of some short-term opportunity. So in that Explore part of that portfolio, which is a relatively small part, but it ends up to be about 14% of the portfolio, we're trying to take advantage of some of the things that you mentioned, and sometimes that might end up having an allocation to a international ETF or mutual fund. For example, we've been in a Japan-focused ETF in the last couple of years in that. We've been in an India one in the more recent past. So those types of trends could end up in that portfolio.
Great. Thank you, Brian, for taking on a couple of our client listener questions and digging into them. I enjoy your commentary always, and I know our listeners do as well. And thank you for listening to our podcast today. If you'd like to give us your opinion on our podcast, in the show notes of this episode is a link to a survey. And we'd like to know what you think about the topics that we talk about, maybe what you'd like to hear. If you just take a minute and complete that survey, we would really appreciate it. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll-free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.